Welcome to LaTour Retirement Talk. I am your co-host, Tony Shore, and once again, I am here with Jim Margraf and Josh LaTour, our hosts who have a lot of great information today. I mean, who doesn't have questions about Roth IRAs, life insurance? How can they help me? How can they hurt me? Can they hurt me? What are the positives? What are the negatives? This is going to be a great topic because I think there are a lot of misunderstandings, misconceptions about how these things work and how they fit in with an overall financial or retirement plan. So can't wait to get to that. First, I do want to ask Jim. Jim Margraf is here, the man, the myth, the legend. You know him. To know him is to love him, right, Josh? To know him is to love him.
Oh, for sure.
Yeah. Wow, Josh is really Josh. You can hardly tell when Josh is lying about that. That's
not an ounce of sarcasm there.
Yeah, there was that was sarcasm. It wasn't lying; it was just sarcastic.
That's right.
It's not lying if it's sarcasm. Remember that, Jim.
Okay.
No, Jim. How are you doing?
Oh, I'm doing very well, Tony. Been able to sit down with a few clients here in the last couple of days to really take some of the worry out of their retirement dreams. And so that's been real exciting. Always love to be able to, when you sit down with someone and you present a plan and they look at each other as husband and wife and they go, hey, this is going to work. And, I get a lot of pleasure from doing that and helping
It's
people
rewarding,
that way.
isn't it?
It's very rewarding.
And that's what it's all about. I mean, that's just that's why you do what you do, isn't it? It's to help people. There's nothing greater than that. Is helping people realize they don't need to be stressed. It's going to work out.
Right.
They've got a plan now in place, and a financial expert on their team to help them get there. Right.
It's like the folks I sat down with this morning. I presented a plan actually, and he looked over at his wife. He's like, well, that's pretty straightforward. This was long overdue.
Yeah, and that's the thing. Yeah. It's like getting to this point where you finally take the plunge, right?
Right.
It's like as a little kid, I was afraid to dive in, to the water, and when I was learning to swim, and the deep end always scared me. And but once you do, you realize, oh man, I'm swimming like a fish here. I could do this all day long, and you find out it's actually fun.
Yes,
right?
Exactly.
Yeah.
Yep. You find out it works, and you find out when you do have a good plan in place that it gives you a lot of peace of mind. Yeah, and absolutely. You're not as worried about tomorrow when the plan is in place. And
there you go.
And let me say a written plan, not just something that you're trying to keep and maintain all the numbers in your head.
Right? Yeah.
Yeah, it's written. It's down on paper in front of you. It is very helpful.
Yeah, it's not written on a napkin from the local coffee shop. It's actually a physical written plan in a binder that's totally tailored to you and your needs, or you and your family's needs. Now, today we're going to talk about an aspect of that. And I guess since you mentioned life insurance and Roths, we're talking about that tax-free bucket today, right?
Yes. I don't know about you, but I really like the idea of some tax-free income.
Yeah, especially in retirement when we're all, we're all living on a fixed income. No matter how much or how little you have a fixed income in retirement.
True.
If you've stopped working.
That's very true. Yes. A lot of people don't stop to think about that, even if they have a lot of income it's still a fixed income.
Right? Yeah, it is.
But getting that tax-free income, so what we want to do is we want to look at a couple of ways, both with the Roth and with the life insurance, because, I don't know about you, but when we look at the Roth, we've talked about Roth IRAs, 401ks, we've talked about those kind of things a lot on the show. There are limits to how much we can contribute and get into those types of vehicles. So that's where the life insurance then comes into play to give us another vehicle that can give us that tax-free income in our retirement years.
Yeah, and that's what it's all about. And you want to have a tax-free income stream to preserve your retirement lifestyle. some people say, well, I'm not going to be paying any taxes in retirement, at least federal. I'm going to be in such a low tax bracket because I'm no longer working. And they don't understand that if they have 401ks, IRAs, or any type of tax deferred retirement account, all that money is taxable when you take it out in retirement, isn't it?
It sure is. I sat down with a couple yesterday, and they were talking about the subject of taxes at retirement. And they said, well, you get past a certain age and your tax rates go down or change, right? I'm like, no, the IRS tax rates pretty much stay where they are.
Yeah.
Regardless of your income or regardless of your age. And they said, it matters as to your income as to what your tax rate is, but not your age. And so, you may get a little extra deduction because you're over 65 on that standard deduction. But your overall tax brackets still remain where they always have.
Yeah. It's just, I think people get that impression because they're told or they read an article where, well, you're going to be making so much less in retirement than you did in your working years that you'll be in a much lower tax bracket. But that's not necessarily true in all cases, is it?
No, exactly, Tony. Yeah, there are people in which their case that's true for them.
Sure.
But I would say it's becoming more and more rare. And
Yes.
honestly, that's not the goal. We don't want to be making next to nothing so that we're not paying taxes. That's not our goal for retirement, generally speaking.
Yeah, if you want a comfortable lifestyle in retirement and don't want to take a huge pay cut, I mean, that's not the idea of retire. That's not a good thing. It's like, wow, look, I'm in a zero tax bracket in retirement. Well, you don't want it to be because you don't have any income. I mean,
Exactly.
That's not the goal here, right?
So you want the income because you took the time and properly planned and prepared for retirement, and maybe you want to have tax-free income because you took the time and properly planned for retirement. Right. So if you structure things correctly, you can have that higher income and not throw yourself into the umpteenth tax bracket. So that's the goal here.
Yeah. Yeah, I can see that. So tax-free retirement income is the key. You want to start with Roths or life insurance?
I think we should start with the Roths.
Okay.
And let's get into the basics. Let's lay the foundation. What is a Roth? How do we start it? And what are some of the rules surrounding it?
Sure.
Well, basically, a Roth is started with after-tax dollars, whereas the IRAs that you were talking about, those pre-tax accounts, it's all pre-tax money. You get a deduction for it, and it grows tax deferred. The Roth, you don't get that deduction, but so it doesn't help you out in this tax year when you contribute to a Roth.
Sure.
But it grows tax free, not tax deferred, tax free. So that when you get to the point in retirement, when you want to take those dollars out, as long as you satisfied the 5-year rule, meaning you've had a Roth for at least 5 years and you're over 59 and a half, everything in that Roth, what you put in plus all the gains along the way, that comes out tax free. And so that is a forever non-taxable group of dollars now. So a huge benefit for retirees because that can't be taxed. And when we talk about where tax brackets are and where they could possibly go, if tax rates were to double, your Roth is unaffected. That means it's so much more valuable. It's twice as valuable as it would have been in a lower tax environment. So getting that set up in the earlier years as you're preparing for retirement, I think is really important.
Well, it's huge. Yeah. And I know that we've done whole shows on just Roths and Roth conversions.
We have.
And we're not going to get into the weeds on that in this show, but if people should not do any of this without the help of a financial services professional.
Absolutely, Tony. And when we look at, those Roths, if someone has a higher income, the higher their income, they're going to get to the place where they phase out of being able to contribute to those Roths, right? So what we want to do here is maybe you want to do Roth conversions because there's no income limit on a Roth conversion. So that is something to consider. If you're one that has a higher income, you'll contribute to the IRA, but don't take the deduction and then immediately convert it to a Roth. That is a way to get there, get to that contribution, those funds into that Roth without having to worry about the phase outs that happen for higher income levels. So,
Right.
when we look at those higher income individuals, at those numbers, over $200,000, you're going to reach that point where you can't contribute to that Roth anymore. So that's where, again, as we mentioned in the beginning of the show, the life insurance starts to come into place. But when you have the Roth IRAs, the 401ks, one of the things we want to think about, though, is contribute to that 401k. Because when you do that, those funds are coming out of your paycheck before you even see it. Again, out of sight, out of mind, get those funds put over there. It's a great way to save before it comes to you. You don't have to consciously then put it into that Roth. Absolutely go ahead and do that. But if you can, you won't want to max out those contributions. So for a 401k, if you're under 50, we're talking about $23,500 this year into the Roth side of your 401k.
Right.
And to an IRA, if you're that Roth IRA, if you're under 50, we're looking at $7,000. So that's a significant amount of money that can go into those tax-free, that tax-free bucket while we're planning for our retirement years.
Yeah, I think that's huge. You want to maximize your contribution and look at the limits. So that's a reason you might want to use both the 401k and an IRA. But and those limits, there are catch-up provisions there too. If you're over 50 or over 63. So it's a lot to keep track of. Again, if listeners have questions, wow, am I eligible to put more in, or should I be putting more in? You're not going to know that because everybody's personal situation is different until you meet with professionals like yourselves there at LaTour or your team there, and you work up a plan and say, okay, here's where you're at. Here's how much you can contribute over here. Here's how much you should be putting in over there. Those types of things. Am I right?
You're absolutely right, Tony. Yeah, you nailed it. I meet with people all the time that don't understand how much they can actually contribute. They think that they're max contributing because, like you said, it's confusing. There's a lot of different dollar amounts, and people get under the impression that max contributing means they're getting the full match, which to me, that's actually a minimum contribution.
That's your minimum, is how much you need to contribute to get the full employer match. That should be the minimal amount you're putting into a 401k or any type of employer-sponsored account that has a match, correct?
Exactly, Tony. That's exactly right. But like Jim said, all the way up to $23,500. And like you said, there's catch-up contributions. If you're 50 or older, that's an additional $7,500 that can also be put into those employer-sponsored plans.
Sure.
So maybe you can't budget putting $31,000 away into your retirement plan, but maybe you can do $16,000 or something like that. So you got to make it work for you, because you don't want to live with your back against the wall and not be able to pay the monthly bills because you're putting everything that you make into your retirement plan. But just realizing that you actually do have some pretty large contribution limits that you can be utilizing, and utilizing whatever you can from a budgetary standpoint.
Right. So like, for instance, Josh, I had a client that we sat down with about 2 weeks ago. They were living on just one spouse's income, and the other spouse was contributing to the max that they could into that 401k. And they had been doing it to the Roth side. And now they're getting ready to retire. And they have she had a very large Roth 401k balance because of doing that. And they've been doing it for quite some time. And so that's a big help, but again, that kind of a thing doesn't make sense for everybody. Sometimes, some couples, they can make it work. But whenever you can get to those max numbers, it's highly beneficial. You're going to have a lot in that 401k when you retire.
Yeah. I think that's huge. So what's next? What else do we need to know about?
Well, again, we talked about the 401k and what the limits are there. Well, let's say you are max contributing to that. You have maxed it out and you want to be able to put away more. Well, you can utilize that Roth IRA or IRA at the same time, Tony. So you can be max contributing to your 401k, and then you can also put $7,000 into a Roth IRA. And so that's an additional money that you're putting away and setting yourself up for better in the future. So take advantage of both. If you're already able to contribute to the max in the 401k, take advantage of the Roth IRA as well. And just like Jim mentioned at the beginning of the show, let's say your income is too high to contribute directly to that Roth IRA. He talked about the backdoor Roth. And that's where you contribute to an IRA. You don't take the deduction. It's a non-deductible contribution, and immediately you convert it over to a Roth IRA. It's a bit of additional paperwork, essentially, to get the same thing done.
Right.
But that's just the way Congress has made it work.
Sure.
Right. Well, that Congress, they like the Roth. And so for all of them, they're going to phase out because of income levels. So they still made a way that they could get their funds into the Roth as well. So, and I just want to put this in here for the person who works for themselves, or husband and wife. They have a business together and they have a nice income, and they don't have any eligible employees for doing some type of 401k. Look at the solo 401k for yourselves. You're going to get to a higher contribution amount than you would for the dollar amount that you make than you would if you had a SEP IRA. So a lot of times people who are working for themselves, they look at the SEP IRA, but if you can do the solo 401k, you can get to a much higher dollar amount based on how much you're making. So you can get to the max contribution, I should say, at a lower income level than you can with a SEP. So I just wanted to put that out there because it is a very great benefit for those who work for themselves.
Right.
Okay. Yeah, that sounds great. Now, back to you were talking about contributing to both a 401k and a Roth IRA, or both a 401k and an IRA. Would you ever recommend, or might it be a strategy? I'm just curious if, let's say I decided I want to contribute to my 401k. I'm going to put in the maximum amount I need to get the full match, but I want to be saving more for retirement. Would you ever recommend that people just put enough in their 401k to get the full match and then take the rest of what they would contribute there or want to contribute or put into a plan and put that into a Roth or a traditional IRA? Yes. Or would you say max out the 401k first and then go to the IRA?
Great question, Tony. Well, I think it's different for everybody.
Sure.
But one of the nice things about contributing directly to a Roth IRA or an IRA is that you have more investment options. Within the walls of the 401k, you're limited. You have whatever mutual funds that they have available inside that 401k, but you don't have the same type of options. When you break out of the walls of the 401k, the world of investing opens up. And so you can basically add it to what you're wanting, because what you want may not be within that 401k. So that's a lot of times the advantage. And the second thing, you can get professional management. A lot of times the issue with employer-sponsored plans is people feel like they get no management. And it's because they get no management.
Yeah.
And so
they don't get any help. Right.
There's a reason they feel that way.
Yep.
And so the person I met with today was telling me that. It was like, we see them once a year, and I don't know anything about this. They don't help me. And I talked to somebody, they just left their job, and they're getting hounded by the custodian, who now wants to help them because they no longer work there, but they never really helped them before. So they never got any management while they were working there for several years. But now that they're retired, now they want to help them. Right. And so having some professional management can be a big help with the IRAs and Roth IRAs. So that's a good reason to be contributing outside the 401k.
And I just want to add one other point in here, because if you're contributing to the Roth 401k, it is a good idea to have a Roth IRA as well.
Yes.
Because the Roth IRA is what meets the 5-year clock that we have to meet before we start to draw all those funds out tax-free. The Roth 401k doesn't help us meet that 5-year clock.
That's correct.
Why the IRS wrote the rules that way, I don't know. It doesn't make sense to me, but it's Congress, so we're going to have to. We've got to deal with it. These are the rules we've been dealt with.
Yeah.
So contribute to, if you're doing that Roth 401k, make sure you at least have some funds in a Roth IRA so you can get that 5-year clock met.
And it doesn't even matter how much you have.
Nope.
As long as you have made a contribution and started that 5-year clock going, that will satisfy it.
Yep. So once you've had it for 5 years, the clock is that 5-year clock for the Roth IRA is met, and now we're good. Now, when you retire and the funds come out of that 401k into the IRA, the Roth side, all of those funds are available to you tax-free.
There you go.
No.
I like it.
Yeah.
Well, okay. So we've really talked a lot about Roths and 401ks. What about life insurance as a retirement tool?
So when we look at the life insurance, we're looking at life insurance to get to the tax-free income. We're looking for a very specific kind. We're looking at something like an index universal life policy, so it's permanent life insurance, not the term life insurance that you use in case you pass and you try and take care of your family. But what you're going to do is you're going to take a policy loan from this index universal life policy, and you're not going to pay it back. You're not going to pay back those loans that you take out of there because loans are never taxed. Did you ever notice that? You take a loan out on your mortgage, you don't get taxed on those funds that you receive.
Right.
So taking it from that life insurance policy, you're not taxed on those funds. And so you don't have to pay it back. It just comes out of the death benefit later on. And you get to have a tax-free income. Now, there's a couple of things we want to think about. So number one, we've talked about this here at LaTour. It is better to start with the 401ks and the Roth IRAs first. But once we've maxed those out, this is where the life insurance really comes into play. So let's say you're the type of individual who has gotten that dream job and you've had that, you've moved up a lot on the pay scale, right? Maybe your pay has, doubled or something like that with this new job.
Somewhere way above the title of radio show co-host.
So, something that's way above your standard of living, right? What you need to maintain it. So you have a lot of extra funds that you're able to put into savings. Put it into this life insurance policy so that later on when you retire, now you have a tax-free income from there. So there are a couple of rules, obviously, with the life insurance. But here's a really cool thing. I don't have to wait till I'm 59 and a half to pull the funds out of there tax-free. So there's no age requirements on the life insurance, right? And there's no IRS hard limits on how much I'm allowed to contribute. It's based on a percentage of our income. So if the higher my income, the more I can contribute.
Right. But and there's always a but in there too, right?
Absolutely.
I mean, you've got to make sure that it takes a long-term, it's more of a long-term strategy. You want to build up a cash value. You want to make sure it's right for your situation. And that's where you guys come in, because there are some people who this is the perfect strategy for them.
Right.
But a lot of people out there might get sold a policy that isn't right for them by somebody who's not a fiduciary or is less scrupulous. And you want to work with a trusted financial professional like yourselves, who are fiduciaries, who are looking out for your best interest, right?
Absolutely, Tony. Yeah, it has to be structured right, and it has to be for the right person.
Right.
Because one of the reasons why it has to be structured correctly is there are ways that it can be messed up. If you're contributing too much to one of these, you can end up, we call it meching the policy, turning it into a modified endowment contract where you don't get those tax advantages. And if the whole purpose of what you're doing is to have tax advantages and you mess it up on the front end, well, that's a problem. And so making sure that you're doing it the right way. You don't want to do this on your own. This is it can be a complicated strategy. You can simplify it, but if you don't know what you're doing, you can end up messing things up. And you want to make sure you're working with somebody who understands it. And like you said, Tony, is a fiduciary. I think that's paramount.
Yeah, not somebody who's just trying to sell you insurance, who works
Exactly.
for a big box insurance company,
Yeah.
but somebody who's doing an overall financial plan, retirement income plan, working with you, your investments, your overall situation, from maximizing Social Security to making sure you're properly insured and not overinsured, and getting yourself into a situation where you lose the tax benefits by getting into what you called a MECH, or a modified endowment contract, right? That's important.
That's right.
Yeah, and I don't want to have to understand this or know this. And listeners, don't panic. They're like, "Oh, this is way over my head. This isn't going to help me." But that's why you're here, Jim and Josh. That's why you work with financial professionals.
Right.
The benefits can be explained simply, but you have to know the strategies, the IRS rules, the policy design, and you have to work with somebody who's really good at that and knows. And just because somebody's been dealing with these a while, it might make them an expert, but it doesn't mean it makes them an expert in whether this is going to fit for you or not.
Exactly.
Right. Yeah. So as you said, Tony, working with someone that's a fiduciary, that's always looking out for your best interests, that's the standard that we go with. That's what we have here. That's what we are as fiduciaries. But looking for that, what is your best interest from the person that is helping you with those finances? That's a big difference than someone that's just going to sell you something.
Right.
Yeah.
So when we look at this, we're sitting down, and after the appointment, after we've sat down with you, then we're sitting down and going through, okay, what makes the most sense here? What helps them the best? And so that's a constant question that's always on our mind. How do we best help this client that we just sat down with?
Yeah, exactly. And for our listeners and viewers out there, I just threw it up there. Before we go, let them know how to contact you.
Absolutely. Well, listeners, just give us a call. Our number is 417-641-3497, and visit our website at LaTourAsset.com.
All right, that sounds great. Again, that's LaTourAsset.com. And that does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour.